Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 12th and 26th. Check out these two exciting two-part events, which we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials. Visit etfmarketinsights.com for more information. And remember to subscribe to our YouTube channel for fresh weekly content. Hit the alert button so you never miss a post.
Hey everybody, it's Larry Berman here, and here's what's on my radar. It's a very busy week in Fed Speak 10, so we have this search capability on the Bloomberg terminal, and you basically type Federal Reserve speakers or Fed Speak, and you get the list. And anyways, bottom line is, earlier in the week, there was a little bit more dovish tilt to the talk. And then later in the week, as equity markets improve, you kind of hear, financial conditions are not tight enough. And it depends who is speaking. But you saw a bit more balance, but towards the end of the week, it was really, we don't want equities to rally here. We're going to have to do more. Like that was the underlying message that I got out of it. And obviously mixed opinions on the street here on how that goes. But, what was clear after we heard from the big U.S. banks in that the credit conditions are, okay. When Jamie Dimon speaks, people listen. And so recession probability higher, but pushed back a little bit. So when you look at some of the other data points we saw this week, the Atlanta Fed wage growth tracker ticked up. So, big week with inflation. Inflation numbers were softer than expected, but we've got this little uptick here in wage pressures. And so when it comes to core inflation, to me, a lot of it is about wages. And obviously services and rents and things like that. And a lot of that stuff is coming down. But this is what the Fed needs to kill to cool the labor market to actually get control so this doesn't turn into a wage spiral. There's a tremendous debate now out there, and I read both sides of the argument where people say the Fed's have gone too far already. Some say they've gone not far enough. And we'll end up seeing, but it appears that things are already breaking. And again, with policy tools, they can put patches and band-aids on these things. This is what turned the tape actually on Friday, because after the bank earnings came out, the tape improved significantly, and we saw an early bid coming out of the 9:30 open. And then at 10 a.m., we got this expectation survey for University of Michigan, and we got a significant jump up in one-year expectations for inflation. This has been generally falling for a number of months now, and we got this surprise uptick here. So what was that? Well, very likely people are starting to see the price at the pump go up. They're starting to see or continuing to see prices starting to increase at the supermarket. And these surveys, almost always, the short-term metrics are what did you pay to fill up your last gas tank and what did you pay at the supermarket this week? And I think on both those metrics, this kind of makes sense. So, what did all that translate into? Well, when we look at the world interest rate probability screen on Bloomberg, we now pretty much have not virtual certainty, but as close as we could get to one more rate hike being priced in. The SOFR, the secured overnight financing rate, futures market, remember this replaced LIBOR, at 97 implies a 3% overnight funding rate, the December 2024 contract. So I think that that's a little bit aggressive. I think what actually makes sense around 96, so that to me is more of a softer landing than seeing rates having to come down to 3 or even lower than that, and to where we got a couple of the spikes in the last month or so there as we were going through the banking shock. So if that banking shock is not systemic, which is what we're the sentiment we're hearing now, then why are we seeing this behavior? So here's a couple ETFs. All of you will be familiar probably with KRE. We've talked about it before. That's the broader regional banking ETF. And only a few weeks ago, Roundhill, and I don't know them as an ETF provider, but newer company, I guess, came out in the US with what they call Big B. And this is the big bank ETF. So again, your Citi, your Wells Fargo, your JP Morgan, basically everyone who reported today. And so what's going on here, folks, with the last few weeks between the broad regional banks, that really the broad economic engine of the economy, and the big banks? The money is floating to safety. When we look at since the beginning of the year, the average and equal weight S&P 500, the small cap index, again, the heart of the broader economy, both those ETFs flattish on the year, up a little bit. What is the FANGMA stocks doing? So Evolve ETF in Canada, ticker symbol TCH, as an ETF here. That's Facebook, Amazon, Apple, what was Google, now Alphabet, Microsoft, and Netflix. So I guess we could rename this to Ma. All the G became an A, and the Facebook became a Meta, and now it's Ma. Anyways, the Ma stocks are Ma momentum, right? And if you look at this and just these names, and you took them out of the S&P 500, you would have charts that look closer to this. So this is a very, very defensive rally. This is not bullish, and caution prevails. So when we get into the bull bear pick of the weeks, and we say, where do we get aggressive? It's not in the big cap tech names. That they have all rallied on the whole idea that inflation is falling off dramatically and we're going back to disinflation. And again, that's the debate, folks. I don't think that's the likely outcome here. So when we look at the S&P 500 and earnings, we've seen over the last year earnings come down. They continue to fall. I don't think this is anywhere close to what earnings are like a year from now. We're going to be sub 200 on the S&P 500. Equity markets are priced for perfection here, and we're just very unlikely to get it. So when you look at this and you look at it coming out of the range, I get it. Technically, this looks very, very constructive. But it's only constructive if you believe inflation is coming down, if you believe that means the Fed is going to be able to ease and stimulate. And I don't think that's what is in their playbook. So be defensive overall in terms of the bear side of things. Where do you get aggressive? There are not too many things right now that look overly cheap. A little while ago, we liked the precious metals. Those have ripped here. Everything's very overbought. I would just be cautious overall. There really isn't a lot to me that stands out right now that I'd want to be bullish on. I know it's not a great message, but have a great week and start enjoying the better weather.
Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 12th and 26th. Check out these two exciting two-part events, which we curated specifically for you, the DIY Investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials. Visit etfmarketinsights.com for more information. And remember to subscribe to our YouTube channel for fresh weekly content. Hit the alert button so you never miss a post.